Hello. On the screen is Adani Ports and Special Economic Zone Limited's Quarter 1 Fiscal Year 2026 earnings conference calls transcript. So, all the conversation that took place in this conference call or in this meeting is all written here. A lot of interesting stuff was said in this con call. So, let's read. So first of all, who's present? Who's present in this con call? So from management side, you can read all these names. Mr. Ashwani Gupta, who is the Chief Executive Officer, Mr. D. Muthu Kumaran, who is the Chief Financial Officer, and we've got other people from management. We have the moderator, Mr. Vijay Kumar, and a lot of shareholders. So first important highlight and question is on page 3. So on page 3, a question is asked that in the international, what is the breakup of the 7.2 that we are reporting? Now, what is the breakup of 7.2? What does that mean? So, when talking about international ports, this quarter, international ports of Adani ports handled around 7.2 million metric tons of cargo. So, the person who asked the question is basically asking there's 7.2 million metric tons. How was it divided? Like which international port brought in how much or transported how much cargo basically? Okay. So in international, Hafia, Hafia did 2.9 million metric tons. Tanzania, Tanzania has done around 3.5 million metric tons and Colombo has done around 1.4 million metric tons. This is the 7.7 million truck. Wait, he is saying 7.7 million metric tons. The shareholder is saying 7.2 million metric tons. Who is correct? Uh, I guess the management is correct. The 7.7 million metric tons was the total cargo carried by international ports of Adani ports this quarter. Highest was carried by Tanzania. Second was carried by the port at Haifa, not Hafia, Haifa. And Colombo, with 1.4 million metric tons, is the third largest. Okay, so one more thing. The management said in the last quarter, there were two things that, let's say, had a negative impact on the overall volume. So, overall cargo volume this quarter did grow, but could have grown higher. And why it did not grow higher was because of two things impacted the negative volume, overall volume. So first one was a negative impact on the Mundra port. Now Mundra port is like the most important asset and port for Adani ports. Uh, Last year, they talked about 200 million metric tons for Mundra. Now, there has been a negative impact on Mundra port. So, biggest impact which came in Mundra is because of geopolitics. So, because of geopolitics, there has been some negative impact on Mundra. All right. So, he mentions, we read the first line onwards, and some of the nights when we had to close Mundra because of the blackout. And I think you understand what I'm talking about. So, because of blackouts, the recent situations, geopolitical, the Middle East conflicts and the India Pakistan conflicts, they both negatively affected the volume, the cargo volume in Mundra port. Now, the second thing is because, hold up, is because of the restrictions which was made by the Indian government for a certain country as a consequence of Operation Sindoor also disturbed the shipping line routes because Mundra is the last call of port before our neighboring country. So because of restrictions made by Indian government as a result of Operation Sindoor, Mundra's cargo volume was also affected. And third, talking about the adjustments, the overall improvement and how is the situation looking for Mundra and therefore the overall cargo volume. So okay, so definitely when we disturb the trade traffic, it takes time to adjust. Okay, and it happened in May. So things started improving in June, and in July, they're seeing that the container volume in Mundra has come back, is coming back, and they're 10% more. So in July, they are 10% more than what we did in June. So that is more on the container and especially in Mundra. So whatever things, whatever impacts were there on Mundra, it will take time to adjust to those impacts, and things seem to be looking back. As in July, the container volume was 10% more than it was in June. So things are improving. Then, second was again, we are still talking about the overall volume, what impacted the overall volume. Mundra's problem was geopolitical, and it seemed that things seem to be improving. The second is about Dhamra port. So Dhamra carries dry cargo, and in the dry cargo in Dhamra, the biggest drop we saw was iron ore. So biggest drop they saw in cargo volume in Dhamra was iron ore. But this is not about performance. This is about again the total trade. So this drop in iron ore was not because of something specific to Adani ports. It was about the total iron ore market, you can say. It's about again the total iron ore market. However, even despite this drop in iron ore, they gained the market share in iron ore by 2.1%. So the entire market, the entire trade for everyone dropped in iron ore, but their drop was lesser than their competitors. So their market share increased in iron ore by 2.1 percentage. But the overall commodity business dropped, which is again as a consequence of international business conditions. So the overall commodity business for this quarter dropped because of international business conditions. All right. Now, they say that in order to offset this, in order to make sure that this drop in iron coal is offsetted by something else, here they say, however, we offset this drop by coal. That's why we started a new berth and we decided to invest in two new berths in Dhamra and then finally Gangavaram. Okay. So in Dhamra, in order to offset this drop in iron ore, they introduced two new berths for coal. They're offsetting this by bringing in more coal. Then finally, we're talking about Gangavaram, the third port Gangavaram, which had an unfortunate incident last year, has come back and picking up well. So, what I would say that with these two or three reasons, definitely we saw a drop in quarter one. But from July itself, it would have, if you would have seen our numbers, we have started recovering it. So three ports, Dhamra, biggest was Mundra, and then Gangavaram. Is that the name? Gangavaram. So Dhamra was the iron ore dropping, drop in iron ore, which is because of international trade consequences, international trade problems. Nothing specific to Adani ports. Then we had Mundra because of geopolitical issues. Then Gangavaram had an unfortunate incident last year, but is now recovering. So overall, there had been a negative impact on overall volumes, but mostly because of external conditions outside of Adani Port's control. And since July, from July itself, not even since July, from July itself, they have started recovering. All right. So they have started recovering. Moving on, we move to page 4, or we're already in page 4. We move to page 6 of this con call. Fine. So question has been asked by an analyst or a shareholder. Okay. Okay, sir. If I may just go into so far for the first quarter, and if I include the July volume as well, which you disclosed yesterday, it seems to be trending slightly below what? It seems to be trending slightly below the fiscal year 2026 guidance on the monthly run rate basis. So, can you give us the moving parts, like how we would catch up to at least the lower end of the guidance? All right. That is the first question. The second question is, and also you can add one more thing is like we see, okay, this is English. Despite this volumes being slightly lower, the EBITDA is still very much tracking your overall guidance, like 22,000 crores. So what is, so if you can just explain the dynamics behind it, how should we look for the full year? Basic question is the first question, okay, first paragraph was the analyst or the shareholder is asking that, okay, so far in quarter one, and even after seeing the July data, the volumes are not on a month, what did you say, monthly run rate basis. Like month to month, the volumes are trending slightly below fiscal year 2026 guidance. So the fiscal year 2026 guidance for the cargo volumes, currently, as of now, seeing quarter one and how the volumes have been going on in quarter one, it seems that they would not meet the overall cargo volumes, would not meet the guidance or the targets. So basically, the analyst is asking that because of this weak quarter one, how will they recover in terms of cargo volumes in quarter two, quarter three, and quarter four to catch up with the guidance? Second is, he's asking that again, overall cargo volumes this quarter were impacted. Despite this, the EBITDA that they displayed this quarter is still very much tracking the overall guidance or meeting the overall guidance of 22,000 crores. So he just wants the management to explain how is this happening, even despite this volume being slightly lower, EBITDA is still on track. So the management answers. Here's the answer below me. Yes. Okay. Yes, okay. I think on the volume front, we have two reasons. The first, I already explained about Mundra, and in July, you would see that container is 10% higher now. So we are recovering back. Hope you listen to my detailed explanation about the volume situation in Mundra. So that will be for sure recovered. So what was the situation in Mundra? Mostly geopolitical issues, and now things are basically recovering and coming back faster. All right, this is the important reason. The second one is that if you know that this year the monsoon arrived a bit earlier, so we should be, and the total energy demand in this quarter dropped by more than the utility went down by minus 1.5%. So power demand for power this quarter went down, decreased by 1.5%. And that is very important. If power demand goes less, which means less coal will be required to make electricity. And if there's less coal, that is bad for Adani ports because coal makes up such an important part of total cargo volume. All right. So the utility generation, this was mainly because of monsoon early arrival. Monsoons arrive early, less heat, less sun, less power demand, less coal. Okay. Now, because if you see just hydro, the monsoon arrived early, hydro went up by 13%. So this quarter two, in quarter two, definitely we are seeing the energy demand coming back. And when the energy demand comes back, definitely the coal comes back, and that will give the answer for the coal. I think rest of all the commodities are in line, so we don't expect much change in the iron ore. I think it will still be sluggish. We're not expecting, we're not counting on it. All right, and they're not counting on it. But the focus moving forward is that on having container volume as well as coal. But in addition, that is based on all commodities. But we also have ports which are really doing good. We see the port Colombo, which is doing better than expected. So Colombo is doing better than expected. Then Vizinjam port is doing better than expected. Gangivaram, is that Gangivaram? Gangavaram is also doing better than expected. And I think all these ports and these commodities we believe to be within the guidance. And as you can see, our numbers from yesterday, it's not impossible for us to make aim for the target. So, long paragraph, what it basically meant was Mundra is recovering. there was a power demand decline for this quarter, but the power demand will come back, or they're estimating that power demand will come back. So basically, coal will come back and demand will improve. And last, some of the ports, it's doing better than expected. So all these things combined, they think that quarter two, quarter three, and quarter four of this year, fiscal year 2026, will be good enough so that they can meet their volume guidance and their EBITDA guidance. Then, this was the volume. This entire paragraph was about volume. Second was EBITDA, that even though volume is increasing, not much, how is EBITDA still on track? If volume is not meeting guidance, according to the at least the quarter one numbers, how is EBITDA still meeting guidance? Now, here is it. Second question is on the EBITDA. I think at first you have seen the EBITDA percentage of domestic ports. So EBITDA percentage or the EBITDA margins of domestic ports is increasing. The focus is three. There are three focuses. Number one is to increase the market share. Number two is to increase the revenue per ton of cargo carried, containers carried. And number three is to optimize the cost per ton. And you can analyze from our profit and loss, we are progressing very strongly in a very robust indicator manner on all three indicators. And the consequence of this, you will see the increase in the EBITDA margin in percentage. All right, they're optimizing costs, they're increasing the revenue per ton transported. So better costs, lower costs, higher revenue per ton, meaning better EBITDA margins. That is why their EBITDA is still on track. Now, having said that, that was only when we were port company and were focusing on EBITDA in percentage. Now, Adani Ports is not just a port company. What are they? They transformed their company from a port company to an integrated transport utility company. And they're addressing various segments, whether it be logistics, whether it be rail, ICDs, which are inland container depots, ICDs. They're extensions of seaports, basically, inland. They have marine, they have offshore, onshore, and so on. Now, they don't have to compare EBITDA percentage with port percentage. And all right, a lot of things were said. The basic thing, the basic thing is the company is no longer just a ports company. They're trying to become a full-on logistics company. Not a logistics company, fully integrated transport company, meaning they will provide all transport services, whether it be logistics, trucking, ocean freight, marine services, port services, all of these services they will provide. They are saying that the financial numbers are not linked to only cargo volumes. All right. And they have other things which are driven by all the other business verticals which are coming up. So basically, how will they meet the EBITDA guidance? By having all these other business segments like logistics, like marines, like trucks. All of these will contribute to rise in EBITDA, total EBITDA, and the situation about ports will also improve and they will optimize costs and all that. Then. Now, analysts ask the question in their logistics business, what is your eventual target for return on capital employed for logistics business? And if you can just add, like, what would be your share in the real market? All right. Clear question, short question, expected return on capital employed in what? Expected return on capital employed in logistics business. The answer is as far as ROCE is concerned, they have told that actually a return on equity expectation is 16% in rupee terms. All right. Management said return on equity. In my opinion, this could have been a mistake. The management could have meant return on capital employed. So I'm going with that. Return on capital employed expectation is 16%. But All right. They expect that we will surpass that amount quite significantly with a good margin once the logistics business grows to a size in time to come. All right. All right. All right. Moving on, we go to the last thing we need to discuss in this con call is page 16. Page 16. All right. This is again about the logistics business. Now, he said that the return capital employed expectations are 16%. Now, the analyst asks, all right, this is a big question. The main thing about this question is the margins for the logistics business. That's all he's asking for the logistics business, which is like not the future of Adani ports, but logistics and marines. These segments. A marine is ocean freight, mostly ocean freight, and logistics can be like trucks, railways, all that. Adani ports does own trucks, they do own railways and all that. So he's asking for the EBITDA margins of the logistics segment. Basically, these margins have been 18% over the last 2 quarters. So the analyst is asking whether they will stabilize around 18% or not. All right. So the answer, very interesting, that they think so we think actually we should creep up in this margin in times to come, and we should get to a number of anywhere between 35 to 40% in 3 4 years. They believe that the logistics margins, the logistic business margins will improve up to between 35 to 40% from the current 18%. Very interesting. And last, they're saying that in the next 2 years, they will start crossing a threshold ROCE. They'll start crossing the threshold return on capital employed. All right, all right. That's all the things that were said in this con call. There are a few more things. You can read this. You can search this on the internet. As a summary, they believe that they can achieve their volume guidance. They can believe they can achieve their EBITDA guidance. The overall cargo volume was weak. The cargo volume growth was weak for quarter 1. That was because of several reasons. One was negative impacts on the Mundra port. That was Operation Sindoor. That was the Middle East, other international conflicts. And yeah, second was power demand was lower this year in India because monsoons came earlier. Power demand was lower by 1.6%. Less power demand means less coal. And because there's less coal, less cargo volume. Overall, EBITDA seems to be on track because of the multiple other verticals, business verticals, especially logistics and marines that is coming up. They believe that EBITDA margins, no, return on capital employed, they will reach 16% is their overall expectation for return on capital employed. And logistics EBITDA margins currently around 18% for the past 2 quarters. They expect this to improve to 35 to 40% within the next 3 4 years. And that's it.